So a lot of investors try to keep a lot of notifications which keep pinging on your phone, a lot of channels that they keep subscribing to. But that doesn't really help in their decision making, nor is it in their core competence to handle that.
So, what is an investor's biggest weakness? So, what is the kryptonite to a Superman investor then?
So you know the story about Achilles' heels, right? There was this king in some Greek mythology. There's a king named Peleus, and he marries this beautiful lady who's a deity called Thetis. And they're blessed with a child, a son. The prophecy is that this son will become the greatest warrior of all time, but will die at a very young age. So Thetis, she's a deity, she's a daughter of the sea god. To protect her son, she takes him to a magical river and immerses him in that river. And that river has magical powers which protects the body of the child. Now, because Thetis was holding the child from the heel, when she dipped the child into the water, the heel did not touch the water. So Achilles had the weak point in his body, which was his heel. So after the Trojan War, where Achilles won the war for the Greeks, Prince Paris of Troy shot Achilles on the heel with a poisonous arrow, and that led to the death of Achilles. So we say Achilles' heels is the vulnerable point of any project or any person or so. For investors, instead of the heel, it is the ear. So investors are vulnerable to noise. Now here we put noise as that information or data flow that is not helping the investor in the decision-making process. So noise disturbs an investor rather than helps an investor. And that leads to bad decision-making or losses that come. All good investment plans are vulnerable to noise. So this is something that the investor has to be careful about. This is your kryptonite for a super investor.
So why does noise impact an investor so much?
In markets, and typically equity markets, there are two challenges that investors face. First, we are at an age where we are bombarded with a lot of information. And the information is multiplied or magnified by the number of hands or sources it goes through before it reaches us. The second challenge or characteristic is, with little information and understanding, people form very strong opinions about the movement of the equity markets. Now, these two combined actually increase the decibel levels of noise in the market. And a long-term investor needs to actually segregate between this signal and the noise. To get an information edge, you should get the right signals within the data. You should not be vulnerable to noise. One of the ways, or a couple of ways of doing that, is that you focus on values rather than price, because values don't change as much. Focus on the longer term rather than a shorter term. And if you are meeting any event in the market, rather than just collecting the knowledge about that event, collect more understanding and analyze the impact of that event. Otherwise, you keep discussing what has happened, but without actually assessing clearly about what is the impact of it. So within the information or data that comes in, one needs to really segregate between what is signal and also remove certain opinions which are not based on thorough research done. And that way you can do a little better in this noisy world.
Clearly, these days investors are bombarded with a lot of data. How does one distinguish between a noise and a signal then?
That's a very important question. When I was looking for ideas that could help identify noise, I came across this beautiful book by Sean Aker, who's written this book called Before Happiness. And he's given 4 criteria by which we can identify what is noise. One of the first criteria he talks about is any information that is unusable by you is noise to you. Investors should develop a circle of competency, and anything beyond that is noise, which doesn't help. So a lot of investors try to keep a lot of notifications which keep pinging on your phone, lot of channels that they keep subscribing to. But that doesn't really help in their decision making, nor is it in their core competence to handle that. So that becomes noise. So unusable is one part. Second is untimely.
Okay.
Here the distinction comes between long term and short term. If the information is not being used imminently and by the time you use it, it's going to change, then it is noise. Suppose you are a long-term investor, a minute-by-minute analysis of the market doesn't really help you because by the time you take your decision, it's going to change anyway, so it doesn't help. Third, and the important one, is hypothetical. A lot of information that comes is hypothetical, which means it's given to you as that this could be rather than what it is. And you'll find a lot of people giving opinions, sometimes not really fully researched. Now, those opinions are hypothetical and may not really help you in your decision making. Some people put it as if they are facts, so that you need to be careful of. And the fourth is distracting. Any information or data point or discussion that distracts you from your core goal or from your process is noise and something that investors should avoid. If you take these 4 criteria and work on them, then you will be able to better identify noise and then separate the signal from the data that you are getting.
So we have unusable, untimely, hypothetical, and distracting.
Absolutely.
Behavioral edge is also about taking advantage of the mistakes that others make. So in the context of noise that we've addressed in this podcast, how can one take advantage of the noise around us?
There is a seminal paper on noise by Fisher Black, where he puts a group of traders as noise traders. These are a group which are short-term traders who react to noise, and typically as a group they lose money. But he also talks about how you can stand against them and make some money also, like being greedy when others are fearful and fearful when others are greedy. So he talks about 4 very distinct points. One of them is when there is a lot of noise in the market, your information edge can help you. If you have the right information, you don't react to noise, but you pick up these signals right, your information is right, you are able to make money out of standing against these traders. The second part is these noise traders do affect the price of these stocks. So they try to incorporate these noise levels which are coming in into the stock prices. So stock prices tend to move away from the fundamental values of these companies. And that creates opportunity for alpha for investors. So many people say that price is always right. Actually, price is not always right. Price is always biased because of these noise elements that are coming in. The third part is noise always creates a certain kind of overreaction, whether greed or fear, and you can stand against it and make money. One of the other important points is the noise traders can impact the shorter term. In the longer term, as things unfold, the prices start moving towards the fundamental value. Now, this also shows how, like Benjamin Graham said, that market in the short term is a voting machine, whereas in the long term, in a weighing machine. So contrarian opportunity here comes in when noise traders are high or they're providing too much liquidity in the market based on noise. But yes, as an investor, people have to look at both things. One, put a process which stops you from reacting to noise. So wear some headphones so that your ears are not vulnerable. And 2, understanding the right information and values helps you take advantage of these noise trades that are happening in the market, and you stand against them.
Got it.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.